Hi guys and welcome back to the channel, hope everybody's doing well. This video will be going over 3 UK stocks which I feel are good buys at current levels, and for full disclosure, I do own the first 2 stocks. If you enjoy the video and you find some value in it, please drop it a like and leave a comment. Stock number 1 is Hargreaves Lansdown, which is a renowned name within the UK finance scene as they are one of the most popular brokers with a reliable track record. Their activity is organised around 3 areas: Vantage Funds Management. This includes the management of unit trusts, equities, bonds, investments offering dealings into single share dealings. The second area is Discretionary Funds Management, and the third area includes the management of corporate pensions, personal pensions, annuities, venture capital trusts, financial advisory and stockbroking services. The share price has been slashed 50% over the course of the last year. And when you get that type of reaction in the share price, it perks me up because it can offer an amazing buying opportunity. Or is this a company that is collapsing? Current market cap sits at 3.8 billion, PE ratio of around 14, a very attractive dividend yielding more than 4.5%. So what's caused this share price collapse? Well, firstly, the overall market sentiment will be a major factor, but of course companies still have to try and navigate these tough times as best as they can. This article back in February gives an indication of why the share price has been falling dramatically. Profit before tax fell 20% year on year to 151 million, and revenue fell 3%, and total volume of net new business declined 28% compared to the prior year. Since 2018, Hargreaves Lansdown has been growing revenue nicely, with earnings following suit. So to me at this stage, this doesn't look like a company in a dire situation, rather than a resetting of valuation. Using simply Wall Street, analysts do expect a dip in revenue over the next 12 months, but heading further out to 2025, revenue could be closing in on 800 million, with earnings following a similar path. The balance sheet shows huge strength with assets easily outweighing liabilities, giving confidence on this company's ability to negotiate economic downturns. Although you can't see all these sections clearly, the balance sheet health check in Simply Wall Street passes with flying colours, with green pass marks across the board. One of the perks of owning Hargreaves Lansdown is the dividend. Since 2017, the annual dividend has increased from a payment of 29 pence per share to last year it was 50.5 pence. We know that past performance doesn't guarantee future performance, but I would still say that over the long term you can be expecting an increase in dividend if future growth estimates are correct. The final dividend for this year is still to be announced, which will get paid out in October. The trading update provided in May highlights an encouraging start on strategic initiatives, client growth of 90,000 year to date with a client retention rate of 92.4%, net new business of 2.5 billion in the period, 4.8 billion for the year, with assets under administration of 132.3 billion. Revenue was 196.5 million, in line with expectations, and also reiterating the full year 2022 guidance whilst raising revenue margin and cash to 30 to 35 base points. TipRanks has a mixed report from 7 ratings in this stock. 2 rate it with a buy, 3 have it as a hold, and 2 with a sell rating, and an average price target of £9.36, which would give about 15% upside from current levels. Stock number 2 is Moneysupermarket, Moneysupermarket Group. I've mentioned this company before and I am a shareholder, so to sum it up in a sentence, Moneysupermarket offer price comparisons looking to save consumers money by switching services like gas, electricity, broadband and insurance. Over the last year or so, Moneysupermarket has been making acquisitions to help strengthen and diversify their portfolio. The share price is down 17% over the last year, but recently had a good bounce due to positive earnings. The current share price gives a market cap of 1.1 billion, PE ratio of 19 and a fantastic dividend yield of 5.6%. I think that Moneysupermarket is more of a turnaround play, as we can see with performance in recent years. Since peaking in 2019, this company has really struggled to get back to the 2019 levels for a few reasons, mainly attributed to COVID and now tougher economic conditions. Over the next few years, analysts do expect that Moneysupermarket can in fact get to previous levels, with growth expected from here on out to 2025, where then revenue should be 450 million. Short-term assets don't cover short-term liabilities, but long-term assets do in fact cover long-term liabilities. And this flags up one area of concern on the balance sheet, which shows 84 million in debt, with all other areas looking in good condition. And it is a bit of a good news story at Moneysupermarket at the moment, as first half expectations were ahead, with a stronger return to growth in travel insurance and travel than expected, and exceptional trading in money during the second quarter, which was driven by attractive banking products. The company reported pre-tax profit of 42.1 million, up from 37 million, with group revenue up 19% at 193.2 million. Adjusted EBITDA grew 10% to 56.6 million, coming in ahead of expectations, and an interim dividend was maintained at 3.1 pence per share. They do note that the remainder of the year will be affected by macro developments, but the board are confident of delivering adjusted EBITDA around the upper end of market expectations. Year-over-year performance shows strong recovery in most areas, insurance the main one up 7%, money up 50%, home services down 59%, cashback wasn't available this time last year, with travel recovering a whopping 698%, so a pretty balanced revenue stream with varying performances across each segment. As I mentioned earlier, Moneysupermarket have been snapping up companies, which could be why the debt has been flagged as excessive. They have purchased City, who operate in the life, travel and pet insurance industries. iSlolly enhances their travel portfolio, with Quidco offering cashback services. The trading dynamics for the second half of the year mention that the car and home insurance market is yet to reach a steady state following FCA general insurance regulation. Money is subject to availability of attractive banking products, travel subject to macro developments with a grim outlook in energy. Tip ranks have 6 ratings on this, with 4 buy ratings and 2 hold, given an average price target of £2.48 or 18% to the upside. And finally, stock number 3, we have Team17, who are a UK based company that develops video games. The company supports both owned first party and third party IPs in its development of publishing of games. The company's portfolio includes over 100 games, which includes the likes of Worms franchise as well as Overcooked and The Escapists. Their business operates under 3 main growth engines, which is the main Team17 name, which is their gaming brand, Story Toys, who are acquired in 2021 and are more geared towards the educational side of things, and Astragon, who were only recently acquired in January this year and are a well-known publisher who designs simulation games. Another share price here which has been cut in half at £4.25 per share, now given a market cap of 618 million and a PE ratio of 23 with no dividend on offer. Looking at the revenue and earnings, it's shown steady growth each year, which tells me this is another case of a valuation reset rather than a company who's in a terrible place. Analysts are super bullish on future earnings, with estimations that this will be closing in on 150 million by the end of 2024, being really profitable at the same time. And I think you can be equally excited to know how well positioned this company is from a financial viewpoint, with a pristine balance sheet showing both well outweigh short and long term liabilities. And this results in an all clear green pass marks from Simply Wall Street balance sheet health check. The most recent earnings were in line with market expectations. Team17 said that the enlarged group, including recent strategic acquisitions, had delivered significant growth against the first half, once again showing record half revenue and adjusted EBITDA performance. Looking ahead, Team17 say that they had a solid and high quality portfolio of new releases planned for the second half, alongside continued back catalogue performance was expected to drive a more second half weighted performance than previous years, and that Team17 acquisition had all settled well into the group. Tip ranks has 3 ratings on Team17 with 2 buys and 1 sell. The average price target is £5.60, which would give 27% to the upside from current levels. And this will round up this month's UK picks. I hope you enjoyed the brief overview into these companies, and I'll catch you all in the next video. Cheers.